Open floor. Thank you, Sheena. Any deals going on?
Hey, Corey. I've got
Ben.
I guess you'd call it a need. Lately, I've been thinking there's probably a great opportunity to learn from somebody who's operating at a higher level by working on their team. So I'm kind of putting myself out there. If anybody is looking to expand their team, maybe as an acquisition analyst or project manager, something like that. I've got a background in architecture and I've been an agent for a whole bunch of years. So, I'm in Washington State. So if it's local, great. And if it's remote, that's fine too. But just looking to kind of expand my skill set by providing value to somebody who's already kind of operating at where I want to be at eventually.
Awesome. So yeah, if anybody's looking, hit up Ben. Ben, you want to drop your contact info?
Yeah, I'll drop my info in the chat.
Yeah. And Ben is very humble. He's a experienced investor as well. So that's a lot to offer there. So right on, Ben. I think I could think of like a handful of people who come on our calls that I think would be good. I think a good match for working together. So I'll hit you up after too.
Yeah, awesome. Thank you so much.
Yeah, right on. And Ben's in Washington State.
Yeah, Washington State. It could be remote too, but yeah, if somebody needs somebody local, boots on the ground or something. I know the local market real well.
I've been Kekoa, and I have been talking. I've been trying to get him to get maybe a meetup or something going in Washington. So I have an excuse. Like we all have an excuse to go up there even more. So hopefully
man.
We'll get something going.
Let's get something started. Get the Washington chapter going.
Yeah.
Oh,
and
hey.
Ben, you're in Redmond?
Which way are you going first? This one?
What'd you say, Corey? I'm in like kind of Mill Creek, but yeah, close.
Okay.
I mean, with clients, I drive all over, so I go from like Gig Harbor to Granite Falls, so wide area I cover.
Yep. Well, Jake, where are you at again?
I'm in Port Orchard, Washington.
Near Gig Harbor.
Orchard,
Near Gig Harbor. Yeah, right next to Gig Harbor.
I know where that is.
Yeah, Kitsap. So.
Yep. So Jake's from Hawaii too. Jake and I went to school together, and Jake's in the game now. He's a private lender on a couple of deals, I think, right?
Just that one. It went on the market, so hopefully I get paid out soon.
Nice.
Once I get that money, so it's been on the market for 5 days now. So once I get that money back, I'll be looking to reinvest it somewhere else. And I'm also working on that Heloc too.
Oh yeah,
nice. I got some stuff off my credit, so I could get my debt to income will be lower, so I can get approved for a higher amount. So that's what I'm working on now.
That's awesome, man.
Leverage that Heloc and invest. Yep.
Well,
yeah, I'm down to hook up with Ben.
Yeah.
Like you said,
awesome.
He probably has more experience than me, but I'm always willing to learn and provide value wherever I can.
Absolutely, that's what it's all about.
Awesome.
So yeah, if you guys link up and share contact. And I guess, does anyone else have any deals or anything to share? Any good deeds? I know that there's a bunch I could share. Just I gotta start coming in prepared. Ooh, okay. Roshan, what's up, Roshan? Roshan's asking, what is a Heloc and how can I leverage it? Does anyone want to tackle that? Chris, maybe you want to, well, why don't I leave this off? Hold on one second. It looks like you're busy. Well, a HELOC is a home equity line of credit. And I don't know what the terms are right now, actually, for HELOCs. Have they been adjusted? I know Lehua, do you do HELOCs, Lehua?
We're actually rolling out in about next week or 2 weeks our first position home equity line of credit, which is good for investors, because what you can do is if your primary residence or one of your properties is equity heavy. You can use a first position HELOC, just like a credit card. So basically for the term of 30 years, as your equity rises, your line of credit will rise, and you can pull money out of your equity to go buy more property.
Yep.
Is
Thank
that with no mortgage on the property? Is that what that means? Like when you put it in
You
first
can have a
position?
mortgage or you don't have to have a mortgage. There's going to be an LTV limit that's going to be set.
Right.
But
Okay.
as whatever the LTV is set at, if you gain equity year over year, your line grows year after year.
Oh, I see. So
Yeah.
let's say they have a mortgage on the property. We'll say 250,000, but then they can also get a HELOC also in first position, same as the mortgage.
What we would do is we would refinance off the 250,000, roll that into the first position HELOC, and then give you an equity line, say up to 80% of the loan, the value of the home. And
Awesome.
basically with
Okay.
these, this is how they kind of do their mortgages in New Zealand. But they turn around and they literally give you a debit card as well as a checkbook. So
Wow.
what for experienced investors and self-employed borrowers who are cash heavy on some months, but other months do not have the finances, when they get the bulk of cash that 1 month, they put that into the HELOC, they pay down the principal, it recasts, the payment goes down. But if something comes up that, say you want to buy a sports car, say you want to buy a house that you know that's in foreclosure, you have that checkbook or that debit card in your hand where you can now literally go down to the auction and say, here's my line of credit. You need the 10%
Right.
down
It's like
today.
cash.
Here, yes,
Yeah.
it's cash equity on your property.
I love that. That's awesome.
That's a
That's
great
awesome.
product.
It's
Thanks for
our company is very ingenious when it comes to rolling out new products that nobody else is offering. And
What's your company?
NewFi Wholesale.
So that's different than a standard HELOC. What is
Correct.
that called?
It's called a first position HELOC.
So are other mortgage companies gonna, there can be a first position loan. This is gonna be different. This is gonna be a first position HELOC.
Correct. So every month it recasts based on the balance, but you can draw on the equity at any time you need.
What's the interest rate right now? So it's indefinite, it's not 2 years,
It's
3 years?
just starting to come out. We don't have the full specs of it yet. Like I said, it's rolling out in the next week to 2 weeks, but the interest rate is usually a little below your 30-year fixed, but it recasts every month based off of the LIBOR and the index.
And so the goal on putting that into a first position lien is to get that paid off in a quick time, just for investors, like they lend it out.
Correct.
And then, okay, because like somebody that would like have like a mortgage, let's say they have like a $500,000 balance, we'll call it 3% interest rate, they wouldn't necessarily want to do that, right? Because if they're not gonna pay off the HELOC in a quick time, is that right?
Correct.
Okay.
I mean, if you have a 3% interest rate, it's not something that's going to be desirable. This is more
I just have to be in Salem at 10 tomorrow.
Yeah, this is more for your self-employed borrowers and your
Got it.
experienced investors, because you do understand right now is the best time in the market. We literally hit the bubble, right? We peaked. So right now, values are dropping. People are lowering the sales price because no one can qualify right now. So what we're doing is we're giving you an option to say, look, if you did a good job all of these years, we're going to offer you this product, which is amazing.
So that's a really cool product. Who asked about what is a HELOC? Who was that?
Rashawn.
So like a regular HELOC though is typically you would go to a local credit union or a local bank and they have certain terms like 2 year, 3 year, 4 year, 5 year. It's at a set rate. It's significantly lower than your 30-year fixed. And you have certain DTIs, like there'll be 80% if it's your primary, 70% if it's your investment. And you pay only, well, the beginning of the year, it was 2.25% for 4 years. And then you pay off the balloon because it's interest only payments. So if you want to be a private money lender, you're not supposed to necessarily pull out a HELOC, but say you have some equity in your house and you're a private money lender and you have 200,000 you can pull because you have enough equity in your house. You pull out the 200,000 for 2.25%, and then you go and you become a private money lender with anybody here, and they offer 10 to 12%. And then at the end, you just say, I need to have my money back. Usually private money, roll in 12-month increments, and then you pay the balloon at the end. I have a spreadsheet that I made from when I was going to do a HELOC comparing like the different banks. I can send it to you if it helps.
I have a question. I don't know if you guys can hear me here.
Yes. Shay.
So hey, how you doing, Corey? Thanks for the invite. So I have a client who is doesn't have the income to justify a traditional loan, but she has a ton of equity in her primary house, and she wants to basically do a renovation and sell it in the next 6 to 9 months. My concern, she's got a 680 score, or she's got a 660. Her husband has a 680, but they're older, right? So they don't have I think their income is going to be with Social Security right around maybe 60, maybe 70,000. So I like this product. I'm not really sure. Her terms right now, she has one lien, which is about 42 grand. The house is worth about, probably about 900,000, right? But she's trying to figure out how to get the money so she can fix it up and then, obviously sell it or buy another property. So, I definitely would be interested in someone who has a product like that, so I could be able to share it with her, so I would, to be in her best interest to try to help her, make her goals happen, right? That's always my goal as a realtor, right? So, I'll just drop my contact information. If someone realistically is doing that, I would like to know how or what we can do to help her. And that would, I'll in on that. But if you know of one, Corey, specifically that you guys offer or something like that, I would love to, reach out to me when you can. Thanks, man. That's all I got.
Yeah, absolutely. No, thanks, Shay, for bringing that to us. I'm not sure too, like maybe Chris and Lehua, do you know like minimum credit scores for Lehua, that first position? Do you know yet, or is the guideline still being made?
The guidelines are still being written. I can get more information for you guys. That's no issue. But basically, our minimum FICO score here, because we're not the subprime guys, right? Remember subprime back in the day? You could go down to 500. We're not those guys. We are a little more risk calculated. So our minimum FICOs usually range between 660 and 680 on our products.
Gotcha. And that's across the board?
Yeah. I believe our DSCR though, you can go even lower, but the pricing is, we're talking hard money pricing on those with the lower FICOs. It's like, it's not ugly, it's not pretty, Yeah. The DSCR, man, that one got whacked. That product got whacked. What happened apparently is everybody wanted to come and play in the DSCR game. Yeah. And then these loans are not being sold to Fannie and Freddie. They're being sold to private money investors, right? So you start bundling these things and you start selling collateral. And once you start sending bulk of collateral of bad loans, guidelines tighten up across the board because the investors do not like that product that you just sold them.
Well, yeah, and it's shifted so much. Like some people I know in the private lending space, because it was really hot this last year and a half or so, where everyone was doing DSCR loans, and when it became very volatile, by the time you ended up closing, like lenders were taking a hit already, right at the table.
Correct.
So it was
all I can say is watch what happens come October 23rd with the lender.
Yeah.
Because they stated they could do it in all 50 states. He didn't need to be licensed, but did not know the ordinances for every state.
Yep.
Yeah.
Well, this is great info that we're talking about, and which leads me to kind of what I wanted to just open up the room to discuss together, which is market conditions, and what's going on with the money, right? Because on the private lending side, there's a lot going on in the backgrounds. Like I haven't confirmed yet, but we know of at least one fund in Washington State that has closed their doors. And then just hearing a bunch more. And what's happening is the big note buyers, I believe, some of them have stopped buying. Like they've stopped buying the DSCR loans. That's for sure. So it's going to be a little bit harder to find DSCR loans. The rates are not going to be what they were at the beginning of the year. That's for sure. So things are changing. And I think now more than ever, it's best to kind of leave the room open to discuss, people's thoughts. What are you seeing across the nation, right? So Hawaii's market, it's definitely slowing, right? But I haven't seen really too much of a drastic pullback, not yet. Has anyone else seen any movement in the markets that they're in, or even if it's on different islands? Ben, how's Washington?
Yeah, it's slowing down here.
Yeah,
We're seeing more things sitting, more things dropping price. Some listings getting canceled in some cases.
yeah,
Because they can't, the market price and what the seller thinks it's worth are not matching up.
yeah. And Washington State, though, like that has been an appreciating market for a long time, right?
Oh, yeah.
And what's the, I guess, feeling of it now? Are companies still moving in, like tech companies? And
Oh yeah, I mean, we still got a ton of employment. Like
yeah.
people are still coming every day. So,
Mhm.
we still have a massive shortage of housing. And that's, I mean, they're building, but they can't build fast enough. So we're never gonna meet our demand. Like we just can't provide that much supply. So I don't think it can fall too much, but we were also appreciating it at an incredible rate and really like unrealistically. So it definitely has to sort of balance out because we need more people to be able to afford homes in the area.
Mhm.
And yeah, it's just been crazy for so many years now.
Mhm. It's just like Hawaii. The supply is just so low. It's almost like it's an Everest to climb to tackle and balance the supply and demand here in Hawaii. So Washington State, I remember, was really competitive as well. And that market, it can swing real quick, right, throughout the year.
Yeah.
Especially in these times. So is anyone in another state, or they're investing heavily in other states, that you could share what you're seeing data wise, days on market?
So
prices?
we're seeing a reduction. Can you hear me, guys? Yeah.
What's up, Alex?
What up? Aloha. So
Aloha.
we're seeing a reduction in offers on our flips in Southern California, but because we operate in kind of different parts of Southern California, we've seen a difference there. So for example, in the kind of lower price point, in the Antelope Valley, houses that were flipping around $225, $250 in that area are still pretty much flying off the shelf, or at least getting multiple offers and getting our prices that we want. Whereas where we analyze some of the Joshua Tree vacation rentals that we had taken down, although we have seen a huge amount of appreciation on them because of the reduction of potential income, because less people wanted to stay out there, and because of the higher rates of DSCR, we've decided to sell a couple of those instead of keeping some of those. And then in the, I see the rental markets, we just bought that 18 unit in Arizona. We're seeing, amazing, like another $100, $150 in rent, more than we expected. And we were pretty aggressive on our expectation. So that's going to be amazing as far as trying to get that one kind of value added.
Where in Arizona is that?
That's in Central Phoenix, kind of close to Scottsdale, though.
Phoenix,
so,
okay.
Yeah, Central Phoenix. But on that side of things, but we haven't seen much there because we only have that one asset. But as far as the single family house, we have seen a drastic reduction in offers. But I think right now we're noticing just people that really want to have to buy are still going to buy. It's going to be a bit of a normal market. If you're used to an inflated market, yeah, naturally, it's this pullback. But if everything's been inflated, we thought we were going to make 40 grand and then we're making 60, 70 grand on these flips. Well, now we have to go back to, making what we thought we were going to make, or we're analyzing more from the perspective of, hey, if this thing's going to go down, these potential properties are going to go down 10, 15, 20%, in the time that we hold them, which is only 4 to 6 months. We're going to have to, right now we're just analyzing deals at buying them at 50%, 50 cents on the dollar. That's it. It's that simple. Like we have a 30% margin for ourselves and not 20% because of the market. And that means that we're going to have to work twice as hard typically to make about the same amount of money is what I'm telling my team. Like, hey guys, if you're not willing to put in 80 offers to get that one deal, then you're probably not going to buy a deal a month at least. If you're only putting in the 40 that we used to get, then you're going to take you 2 months to get your next deal because we need to buy them deeper. So kind of on that, and then we're just not interested in buying some of the more the oddball properties because those are going to sit for sure. But we also have seen a large, or just the days on market to be creeping up as well. But again, the houses are selling and we are getting our numbers. But how long will that last? We don't know. Our main objective, because we do have 14 active deals as far as what we're working on right now, they need to be turned fast. We need right now. It's like you got to get stuff to the market. You got to get whatever you were working on whatever project. Make sure you're speeding that up because every day is even more critical now. And then once all those are listed, we're going to list about 3-4 properties. We're going to analyze that data heavily. Like, do we get a price where we at? We're also going to be listing property much less than we thought, so we can get a lot more people look at it because buyers are now thinking they're in the driver's seat, which I mean they kind of are, but we're buyers as investors too. So we're going to see that you just got to make sure where are you going to benefit from, right? You're going to benefit from the sell side when in a seller's market. Now, how are you going to benefit in a buyer's market? Because that's the psychology now.
Yeah. Oh, there's so much I loved about what you just said. Thanks for sharing, Alex. That's surprising because Phoenix is one of those markets too that can swing real quick. So, but you're talking about rents. So rents have increased more than expected. Yeah. Correct? Perfect. Okay. What about the housing market, like sales? Have you seen anything in Phoenix?
Well, we're not really operating single family space in Phoenix.
Gotcha.
We're interested more in the single family there. Yeah.
Yeah. Well, I'm glad you mentioned that because one, there's many things that you said that stuck out to me is one, you're having talks with your team about, hey, like things are changing. We need to adjust, right? So that we don't go over the falls on this wave that we may be catching, like let's get ahead of it and ride this thing. So I think looking forward thinking is important. And that's why I was going to ask you one of my questions, but you already answered it, was what percentage, maybe not in Phoenix, but like in the market that you guys are flipping and doing sales, are you already knocking off like a certain percentage of your ARV going into a deal? And if so, by what percent? In maybe
10 to 20%. If we think a house, right now, if I'm looking at a deal to flip and I think it's going to be worth, say, $500,000, well, we're going to, depending on what neighborhood that's at, we'll probably say, no, that's going to be probably worth 450 or something like that, 440. It's not an exact science, right? Because it also depends on the deal, how much rehab is involved, and also, another thing that we're doing a lot of right now is we're calling a lot more of the active listings to see what's happening from that market and what kind of feedback that agent is getting on an active listing that might be a competition for us or similar product that we might be putting on the market. And we're also calling the pendings a lot more and seeing where they're at in escrow. And that way you can kind of see where the market is trending as well. I think that's going to be even more important too going forward.
Yeah. Oh, great advice. Now more than ever, you do want to take the temperature of the other side, right? Like, because the worst feeling is going to market, working so hard, going to market, and then crickets. It's like that's the worst feeling, man. And then the next open house, crickets. No offers, so I don't know if many people on this call have experienced that, but it is scary, especially when you're paying hard money rates and you need to pay this thing out in like maybe a few months. It can get scary. So we've been
another thing I wanted to say, since I I decided to sell my Maui house because of the, you know, where the kind of market is at as well. I mean, I didn't really want to sell it, but we couldn't get a favorable DSCR loan. We couldn't really legally do Airbnb on it. We had to put a lot of money down to get the deal, and it's appreciated a lot. As much as I hate to sell it, but I mean, there could be close to, you know, $1 million of potential profit there on that one deal alone. So, you know, my partner Ethan and I just decided to sell it because it's just not one of those things that, like, if the things do change, you know, we can't cash for it on a long-term rental either. So just like every way we try to cut it up to keep it, it just didn't end up working out. But the year and a month or two that we've held it, I mean, things done very well. So it's kind of time to take some chips off the table, get cash heavy, FICO ready, as one of my guys said. And I mean, you know, it's like in real estate investing, you got to make what's most logical, what's most rational. You got to use reason. And sometimes that comes with some very tough decisions that you have to make. And that for us was one of those. Like, we waffled forever. I'm selling, not selling it, but it's getting listed next week. Let's go.
Yeah, nice. Well, congratulations. And like, I think it is important to have the oh shit plan, right? Like, when stuff is happening quickly, it's like, okay, what's the plan here? Initially, like, I've been thinking for a long time, and my thoughts were, if the market starts turning very quick, the last thing you want to be holding on to is dirt, right? So if you're sitting on land and your plan was to develop maybe single family homes, apartment complex or something, like, you might want to think about whether or not you want to execute on that, or just kind of exit and maybe sell the lots or sell the land. But it really is timing. And the problem is nobody knows, nobody controls the market, and nobody can predict the market, right? Like, even if you ask some of the smartest guys closest to the money on our MPLA calls, even they are like, I don't know, you know, like, all we can do is try to be proactive, right? So, but the gathering intel from, like, Ben, what's going on in Washington, and Alex, what he's seeing in California and Arizona. You know, if we have anyone from the East Coast, that would be great and interesting to hear what's going on with projects on the East Coast. Does anybody have anything? I know there's a lot of people in kind of the Midwest. I think Indy, St. Louis, Missouri, Tennessee. Hi, Jana.
Oh,
Did you
hi.
accidentally unmute?
Oh, did I unmute? Sorry, no, I don't have anything. Sorry.
Oh, no, it's okay. Yeah, no problem.
Hey, Corey,
Okay.
I got stuff in Atlanta.
Oh, hey,
And,
Jason.
we're definitely
perfect.
seeing changes. Yeah. So, you know, I'm kind of small volume, but one of my coaches is a big volume guy, and they're adjusting their ARVs down 10%, and they're only buying at 70% of ARV, when, you know, they were buying even up to 80, like last year. So everyone's being a lot more conservative in the purchases.
Yep.
And they're noticing a lot more, and I haven't noticed it because I'm not all over like them, but what they're saying is it's very neighborhood based. So, you know, Atlanta has just like a fundamental housing shortage, so real estate in general is good, but certain pockets and certain suburbs have slowed. So they have like units that are kind of just sitting there, but then in like other pockets, like in the city, they're still getting 20 offers. So it's super like localized to the product and neighborhood. So
that's
interesting. My takeaway from my conversation was be really conservative in your underwriting.
Yep. Thanks for sharing, Jason. I think in Hawaii, like right now, kind of similar to what Jason said, like a 5 to 10% adjustment on your ARVs, and maybe like another 2 months to be safe extra on your holding times, you know. But I think it's will we lose out on deals because we're being too conservative for the time being? Absolutely. You know, we're going to lose out on deals when you adjust your criteria, but that's what separates us from being, you know, onesie twosie here and there, real estate investors to actually, professionally trained and savvy real estate investors, right? Who, it's okay to lose a deal. Just because you win a bid and you take down a property doesn't mean it's a deal. You might have actually lost when at the moment you close on that deal. You don't know, right? So it's better to be safe, right? And we have to go back to the fundamentals, and the fundamentals are understanding the three types of appreciation, right? There's instant appreciation, forced appreciation, and market appreciation. So, of course, the most powerful form of appreciation is instant appreciation, because we can control that, right? And that's buying it with instant equity, or you're buying it at a price where you know that you're going to profit on the back end. That's where they're saying you make your money when you buy comes from, right? So the second form is forced appreciation, which is repositioning an asset, whether you're building ground up construction or renovating, or maybe you're buying a bunch of furniture for your short-term vacation rental, and you're going to take out with a 30-year. That's forced appreciation. That is the second most powerful form of appreciation, because you're semi in control, but it's still arbitrary, right? We're all guessing at the end of the day. If we put $100,000 into this property, it's going to increase the value by $250,000. That, we could assume that because that's what the comps show, but nobody really knows until you put that thing on market and see how the market reacts. But
Hey, Corey.
Yep, go ahead, Kurt.
I got a marketing concept for you guys.
Yeah.
Don't mind the noise or renovating. Here's the concept, and I was going by what Alex was saying about, hey, we got to liquidate our homes, okay? And when I say this, just roll with me, okay? Section 8, okay? Find the owners of Section 8, because they could be tired of handling their unit, and that could be a cash deal. Don't worry about J1 is as is. If you can find Section 8 owners of buildings, and if you want to help veterans, so if you buy the unit, and now instead of for the state, you say, I'm going to give it to vets now, retired vets who need a home. It's just an idea. Think about it. Find section home. You know where the second home places are, right? You don't need a farm list for that. You know where they are. And then if you can contact me, I can help you probably get the owners of them, and I will start marketing to them. They may or may not. They may say, no, it's easy money for me from the state. I'm going to keep my unit. But some like, you know what? I want to get out of this. You have cash for me on this? Okay, I will buy it as is. You buy the unit, and then you talk to the vets and just say, I got a unit for you to rent. I'm trying to help out the veterans. And it's just an idea, the concept. And that's how you guys got to think about. There are homes to be sold out there. It's a matter of where they are. So I always go by fishing. When you guys go fishing, you're like, how come the fish not biting today? Well, change your bait. You change your bait, you'll catch more fish. So what are you doing to change your bait? You can have the best pole, the best hook, the best lure, whatever, the best fishing spot. But if you don't have the bait for it, they will not bite. So keep that in mind. So I hope that it's just a concept, and you guys can roll with it.
Yeah. No, that's great, Kurt. Thanks for, I mean, in this environment, there's going to be different opportunities. Like the opportunity is going to shift, right? At the beginning of the year, like Lehua was mentioning, the DSCR loans were the hot stuff. Everyone's doing BRRRRs, and we started at 3.25 on a DSCR loan. Now we're like starting at 7. It's like it's changed so much in half a year, 6 months. So do we just like stop and go sit on the sidelines and put our hands in our face and kind of just pity party all day? Like, no, we're going to pivot and we're going to switch strategy. That's all it is. I mean, when markets turn, whether towards the top or the bottom, like that's when, things get exciting. It should be getting exciting, but we got to make sure we're on the right side of this. And that means now more than ever, right now is when we have to be more aware of what we're buying and hedging our bets, because if you're buying stuff right now in a time where there's a lot of uncertainty, a lot of volatility in many different sectors, then if you're buying stuff like how you were buying at the beginning of the year, then you might end up on the wrong side of this, So it's just my humble advice is we heard from people on the call who are investing in different markets across the nation. They're all saying the same thing. It's pulling back, right? Maybe not so drastically in some areas, but either way, things are changing. So we need to be more cautious on what we're buying right now, because 6 months from now, who knows? It could be worse,
I mean,
it could be worse, and you could be stuck in a deal
prepare. It's a good point, Corey. Prepare. It's gonna go 7%. I'm sorry to say, but interest rate will hit the 7% this year. I just have a feel. However, if you look what Corey's talking about 6 months from now, guess what's next year, 2023? It's an election year, and we don't know what color we're gonna be, red or white. It's gonna be a interesting year in 2023. So prepare and always find out where they are. Someone's always getting a divorce, fortunately. Someone's passing away, unfortunately. Someone's moving out. There are movement out there for homes, and you just got to find different ways to find their homes. And I've been working with Corey, if you don't mind mentioning Corey, that I've been trying to help him find those homes to get you closer to what you guys looking for, because what you guys on the call, you provide that red cape around your neck to fly in and help these people and say, I can help bail you out. I got private lender, I got cash for you on there. So there are homes out there. And Corey was saying, not sit in the corner and just cry. You got to make a change, right, Corey? And you got to adjust to what the market is. But sorry, I'll shut up now.
No, Kurt, that's great words. And it is important. It's funny because I almost have a deja vu feeling, because we started this whole coffee talk call 2.5 years ago, right after COVID, right? So when we started this call, this is kind of a similar environment where nobody knows what's going to happen. The market's moving here a little bit. And so, but it's always comforting to know that we can come on every Friday, talk stories, see what's going on, and kind of just, take information from everyone and then make your own calls, right? But I've heard many times, and I've asked this question myself before, until I understood what it meant to be on the right side of a turn, because things are being repriced right now across the nation, which is actually, I think, healthy. I think it's a very healthy repricing right now. But if it keeps going, then there's going to hit a point where it could get bad, right? So I used to always wonder, people say you want to make sure you're on the right side of any market correction, and I was like, okay, well, how do you get on the right side? What does that mean? What do you do, right? And well, the number one thing you do is you have to look at your what you're doing and assume and look 1 to 2 quarters ahead, assuming that the market conditions may change. Because even if you're flipping houses, right? Flipping houses is it's risky, but you're in and out. But when the market is volatile, it can swing pretty quickly, especially when they're jacking up interest rates to battle inflation. And then we have supply chain issues, and then we have a war that's going on. So there's a lot that should be indicators, at least for us to look at what we're doing and adjust our criteria right now. Not when the next project, after we buy this next one. No, right now, let's start thinking about being a little bit more cautious, because things can change fairly quickly. And I'm not saying we should analyze and bask in our fears and stay on the sideline. That's risk too. I just had a conversation with someone last night about this, and it's it's costly to get into the game, but it might even be more costly to sit on the sidelines, because every day that goes by, you're losing time. We're not getting any younger, and so it's very costly to stay, paralyzed on the sidelines too, because 1 year is going to go by, another year is going to go by, and then before you know it, the game's over and you never got in the game, so we don't sit on the sidelines. We still participate, even if you have no money or no deals. Don't just sit on the sidelines. Come on the calls, go to the meetups, right? Provide some sort of value, stay in the game, like stay in the conversation. That's how we get through this, is together. So does anybody else have anything?
I want to go ahead.
Oh, hi, Jana.
Oh, hi. Can I chime in now? I just wanted to share a little something about the, like there is definitely a market shift and change in Heloc as far as the new house builds. We just finished a 2,800 square foot home that, like, right when we listed it, like the interest rates shot up to like 6% and stuff. So we did have to drop the price of the house a little bit, but we're still in profit. We're not losing anything, but the shift is definitely taking place. And then recently, I have a colleague that I'm working with, and we're going to see if this works out. She is a senior loan officer from a mortgage company, so we're trying to prepare families to already purchase homes, to get them in that position. So, with her creative,
I think we're having a hard time hearing you, Jana.
Yeah, Gina, it's a little soft.
I live in Wamanalo, and there's a lot of road work because Obama's moving in. Shucks, so sorry. And I live right on the highway. What I was saying was there is a market shift, in Hilo as far as the new home builds and stuff.
Okay,
But houses are still moving. We're not selling them at the prices that we've listed for, like before. They fly off that, 2 days are out of the market and over asking, but they're still moving. So we're not losing anything. But yeah, definitely a slowdown. And then what I wanted to say was I'm working with a colleague, and we're going to see if it works out. But she works for a mortgage company, and we want to prepare families to be in the position to buy when it's time, no matter what the market rate is at, the interest rates. So far we have a couple of families in the pipeline, and I think that's what that's about preparation, right? Because we can't really fight what's coming, and we just got to prepare very creative with other ways. So yeah, definitely a change in the market, but it's nothing. I mean, yeah, I'm sure we're all like nervous at some point, but there's still, you have to keep active, you have to kind of be working to set things in motion, because it's coming. You just got to be ready. So
yeah. Oh, that's good to know. So the market you've noticed a difference, a slowdown in the Big Island side. So because we have a lot going on out there now. We're heavily invested over there.
Yeah, yes, for
nice.
sure. But houses are still selling, just they're not on the market for 1 or 2 days. They're sitting a little longer.
More like 5 or 6 days. Yeah. No.
Yeah, pretty much, or like even 2 weeks is long. Everybody gets nervous when it's 2 weeks, but but it's still moving, and the one good thing that I like about, hopefully this works out with a mortgage loan officer, is that there's no middleman. Like, she's able to do all of the transaction papers as far as like, when it comes to real estate fees. So like there's no agent fees. And so when we prepare the families to get into the home, like there's no middleman fees that they have to pay out of pocket,
Yeah. Thank you, Jana. Alex, you got something?
Yeah, I just wanted to add to what you were saying, is that, I read this book by Howard Marks. I think he's an incredible investor. I think he invests in like debt stuff over on Wall Street. Highly recommend both his books. The Most Important Thing and Mastering the Market Cycle. But, what he basically says, that resonated with me a lot, which was there's these two risks. You have like the risk of losing money and genuine losing principal, and then the risk of missing opportunity. And what's interesting is that those are constantly in conflict with each other, where we're like, all right, well, I'm going to sit on sidelines for 6 months. Well, yeah, you could do that. But then if you're missing an opportunity, just acknowledge that that's what you're doing and you're playing on the safe side. Great. But know that you are missing the opportunity. Don't be like ignorant of that. And then there's like genuine potential for losing principal, losing money that you actually invest, or even worse, your investor's principal. So I constantly think of that, like, what are the opportunities, but also, how can we make sure that we have, deals that have very low downside with a lot of upside and multiple exit strategies. I think that's the mindset to have right now, because even say, for example, that, because I don't think it's just going to fall off the cliff, and it is neighborhood and area specific. But if homes are going down, in price this much, I'm just using this kind of example, like, this way, but then people are planning like it's falling off a cliff, then there's definitely gonna be opportunity during this transition. So that's kind of my thoughts on that. So I'm doing a lot of thinking about it. I'm looking through all of our inventory. I'm talking to mentors. I'm talking to people across the country. Why? Because the more data points, the more people that that you can lean on and ask, then you're more informed, right? What's really happening, and enables you to make better decisions. That's my 2 cents.
No, yeah, that's great. I love that. It does seem like opposing views, like, because like there is something known as opportunity cost, right? So, and that one's dangerous because it's lingering out there. People don't really think about that, right? Like someone that's sitting on the sideline, they think, oh, I'm just being careful. I don't want to lose money. He's like, yeah, you're losing out already, just by staying stagnant, right? And so for us, like right now, we are on a capital raising binge, and I'm just bringing in money. Perhaps nothing's gonna turn, and we go back to business as usual. That'll be great, and that money is gonna cost me money, but I think that it'll be cheaper for me to pay that money to hold cash and sit on it for a little while, maybe even up to a year, instead of not being cash heavy and ready to take advantage of opportunity if it comes. So even though I may, things may return back to normal and be, we might be going back up and to the right again, perhaps that could happen. So if I'm paying money and that does happen to hold this capital and I lose, that money, in my mind, I'm thinking, well, I could have lost a lot more in opportunity costs if I didn't start stacking up cash now to be ready to deploy, right? Because let's just be real, right? It's almost cliche now to say that like some of the most wealth was built in times of a down market, in a buyer's market phase one. So, because it's true, and I haven't been able to be a part of that, because I came in 2011, 2012. So I've been going up and to the right, like everybody else over here for my career, but if it does happen again, I'm gonna be prepared, because that's like the Super Bowl, that's why, this is what we've been preparing for, our whole career, is when to pounce on this opportunity when the market turns, that we can take advantage of being on the right side. So, and I think a lot of what Alex is saying, a lot of what everyone's saying here, I agree with. That who knows what's going to happen. We are already seeing changes, so it's not something that we should overreact on, because that happens. But let's use what, like Alex said, data points. Let's find our indicators, and then be very conservative, but also be ready to jump on opportunity. Alex, before we wrap up, what are you guys doing to prepare for any turn? I know you said you're selling the house in Maui, so you're gonna get liquid a little bit, and then are you buying? Are you slowing down on buying, or are you ramping up, just adjusting your criteria?
Well, I think right now, for that initial kind of jolt in the last couple of weeks, it was like, all right, guys, let's not buy anything. It's just a great deal. A great deal. You guys know what a great deal is. They've been trained to know what that is. And then we are not stopping buying, but we're simply just, it has to be like 50% off. That's it. Like, bottom line right now. And so, because what can happen if you're conservative and you buy something and things don't go down as drastically as expected, then what you're going to make very good money. or at the very minimum, then you won't lose that much. You won't lose, and then you'll have another data point, a strong data point, because you took down that property, and because we flip, and most of our stuff is, I do want to have that context that most of our stuff is cosmetic, entry level, single family in Southern California. So if the house drops in 20% in 4 months, 3-4 months that I own this thing, well, the whole world is, there's going to be a lot of opportunity, but at least we're going to know that firsthand. And so that's kind of the approach we're taking. We'll keep buying, but with caution.
Yeah. Okay. Gotcha. Yeah. Sometimes you got to send the tracer rounds, like you take down a deal. It's like, it's like, okay, normally, but it's like, I got to get a feel myself of what's going on. Like I got to put this thing on the market. I got to deal with the contractors and the scheduling and the lead times to feel it, like that's how you truly get a pulse on the market when you're actually in a deal. So yeah, I love that. Well, does anybody have anything to add before we wrap up this week? Bottom line is there's going to be opportunity either way, so as long as we're getting second opinions, third opinions, coming on the calls, being a part of the community, you're in the game, we'll all be fine either way. But we want to try to, if there is a turn, we want to be on the right side. It's like, that's what I'm preparing for. So, all right, guys.
Thank
Well,
you.
thank you for jumping on. Thank you everyone for sharing. I got a lot out of that, everything that people said. So have a great week. Happy Aloha Friday and have a great weekend. Aloha, everybody.
Have a